So our discussion is about derivative securities and options in specific. So what is an option? Well, option is a financial security, a derivative security that gives the buyer the right to buy or sell an underlying asset. Now, notice I did not say the investor, because buying an option is not an investment. You're almost betting on a underlying securities price to change. So let's take a look. I pulled up Yahoo Finance and Apple's stock price, which is actually trading at $198.78. So today is a Sunday, so the markets are closed and we cannot trade. However, so this was the price of Apple at the time of closing on Friday. So 4 p.m. New York time. So let's take a look at options. So there are two types of options, a call option and a put option. A call option gives you, the buyer, the right to buy, and then the put option gives you, the buyer, the right to sell. Options are derivative securities because they are not actual products, if you will. They're written on other real assets, such as other equities or bonds or futures or indexes on other financial securities. So in order for anybody to trade a stock, you need the actual stock. In order to trade a bond, you actually need the actual bond. In order to trade a real good, you need the real good. However, with a derivative, it's just a promise that you're buying or you're trading. And because it's a promise, you don't really need the product. Therefore, it is the promise of the product that is being traded. Therefore, you can generate as many options as one can. However, when you're trading a stock or a bond or a real asset, you are basically limited to the number of shares or number of issues available to own. However, with options, there is no such limitation, and that's why they're referred to as derivative product. So an option is a promise by the writer of the option to the buyer of the option to buy or sell an underlying security. So with a call option, we as the buyer have the right to buy the underlying asset, in this case, Apple or Apple stocks. With a put option, we have a right to sell, as the buyer of the option, the underlying asset, in this case, again, the Apple. So let's assume that we are buying an option. Well, first of all, notice there are maturity dates, which simply is specific to the options in the sense that your promise to buy or to sell will cease to exist at the end of this date. Now, the maturity date is specific to options because when you're trading a stock, stocks don't have a maturity date. You own it outright. And you can hold it until the company goes bankrupt or there's some odd issue. However, you own it. There is no maturity date on it. But a promise to buy or a promise to sell, an option, has a maturity date, has a deadline. So for this example, for instance, these are the options that mature on June 28th, and that's Friday's end of day. Now, these are AM traded, so they actually have a calendar date, and therefore the end of closing may not be the deadline for the exercise of the option. So end of day is actually the deadline for the option. So let's talk about these couple of terms. So let's say that we actually are planning to buy a call option on Apple, which means that we are looking for the right to buy the underlying asset. In this case, we are looking to buy Apple shares. Now, notice right here that the symbols for these options starts with the underlying asset and then the maturity date. So 19 is 2019, June 28th, call option has a strike price of 131. So if you go down, you'll see there's a color difference between these two, and I'll explain that in a minute. Apple, 2019, June 28th, call option with a strike price of $200. So let's take a look at the puts. So this one, for instance, Apple, the underlying asset, 2019, June 28th, put option, 162.50. So if you were to trade this, or if you were to buy this, right, we have what's called a strike price. The strike price is the price that you have the right to buy the underlying asset in the case of call, and the strike price is the price that you have the right to sell at in the case of the put options. Now notice they trade very much like stocks or any other security, that they have a bid price, they have an ask price, and they have a loss traded price. So this specific option is being traded at or sold at $2.05, and somebody's buying it at $1.99. So when you buy an option, you're either buying it from somebody who's writing it, or you're buying it from somebody who already owns it and selling it. So anybody can write an option and anybody can buy an option as long as you meet certain criteria. Option trading is regulated, and therefore you need to meet certain criteria in order to trade options. But once you own it, it is an option for you. Once you write it, it's an obligation. So when you buy this call option, you have a right to buy Apple from whoever originally wrote it at $200. For this option, right now, if you were to buy this, you would pay about $2 to own this option. Now, up until next Friday, you now have the right, once you buy this, you now have the right to buy Apple at $200. Now, if Apple is right now trading at $198. If Apple price goes up to say $210, you have a right to buy Apple at $200. Therefore, you could exercise your right to buy this underlying asset, in this case Apple, at $200. And because the new price is at $210, you could immediately sell those Apple shares that you just purchased at $200 and sell them at $210 in the spot market, in the immediate market. Now, notice I use the term exercise, which means that you basically call on your broker and say, I like to exercise this option and I like to buy underlying asset, Apple, at $200 as promised. And you will end up buying them at $200. Then you could keep those Apple shares, you could sell them. If the immediate price trading in the market is well above 200 or above 200 and you wish to sell them, then you can for a profit. Now, this is rarely done because most of the time, the price that you actually see here will increase, because it's a call option, with the increase in the underlying asset. So all you have to do may not be to buy and sell, or in other words, to exercise, but you may just have to just sell back the option at a higher price. So if that's the case, you will realize the same amount of profit. Now, again, notice that this is a strike price of $200 with an expiration date of June 28th, currently trading at about $2. Now, notice there are two items right here. It says volume and open interest. Volume is the number of contracts that change hands, and open interest is the number of contracts that are available to trade. Now, notice I use the term contracts. Options trade not in singles, but in contracts. One option contract will most of the time include 100 shares. In certain cases, there are what's called mini contracts, which will include 10 shares. But most of the time, you're going to have 100 shares in a contract. So a volume simply means that 11,000 contracts has changed hands on Friday, on that day. And there are 7,801 contracts available for trade. Now, anytime somebody writes this option, this specific option, for the first time and sells it to somebody, this will go up. And anytime somebody buys back a written option, so a writer writes it and then buys it back. When he writes it or she writes it, it goes up. When he or she buys it back, it will go down. So when an option is exercised, this will also go down. Same thing for puts. Notice that this, for instance, gives you the right to sell Apple at $195 and currently trading at $1.22. If Apple were to go down to say 180, you now have, as the buyer, this option to sell at 195 and immediately buy it back at 180, which is the going rate or the immediate price. So this 195 gives you the right to sell Apple shares at 195 until June 28th and the day, and this privilege will cost you $1.22. Now notice in both examples, I used a profitable example. In a call, Apple went up. In a put, Apple went down. What if nothing changes? So for instance, in the case of the call, what if Apple simply just stays below $200? Or say go down, say to 180. In which case, well, your option would be worthless. It would just die. And because it's an option, you don't have to buy them at a $200. You would just let it die. And once it dies, matures, expires, then that's it. The only thing that you lose is the premium that you paid. Now, notice, this is why I did not refer to it as an investment. An investment that you buy, investment is something that you buy with the hope of a return. However, you invest in it. Now, with an option, you're basically risking your entire money in a security or in a derivative security that will expire on Friday. Meaning on this date, if Apple is above this, you make a bit of money. If Apple is really, really high and really above this, then you make good money. But if Apple is at or below this level, then you lose money. And you lose your entire money that you paid to purchase this option. So it is not an investment. You're buying a product that has a deadline. It is a lot more akin to buying a lottery ticket. Now, a lottery ticket, you don't get your money back unless you win something. And it has a deadline. Once that deadline is passed, that's it. That lottery ticket is worthless. So a lottery ticket, is it an investment? In my opinion, it's not. It just, you pay a bet or you place a bet and then you buy a lottery ticket and you either make money with it or you lose it all. With an investment, there's the risk of loss, but a lot of the cases, it's not a risk of loss of all. So with a put option, you have the right to sell. With a call option, you have the right to buy. And oh, by the way, because you have 100 shares in a contract, if you were to buy this, you pay $2.05 per share. That makes it $205. So for instance, if you were betting that Apple is going to be above 220, then this would cost you $4 a contract, per contract, plus the commissions that you're going to pay to your brokerage company. Now, notice this is still going to die in June 28th, which is next Friday. And this is betting that Apple is going to go above 220, and it actually is selling at 4 cents right now. So it's pretty far-fetched. Now I said I'm going to explain why this is blue and this is not. So if I were to buy this right now, let's assume that we're talking about during Friday, I could exercise this and immediately sell it back into the market. So notice Apple is trading at 198.78. So I could buy this underlying assets at 197.50 and turn around and immediately sell those Apple shares that I just bought through this option at 198.78, which gives me $1.28 profit. Now notice, obviously the price for this is too high. However, I have what's referred to as exercise value or intrinsic value. 198.50, I exercise and then immediately turn around and sell those shares that I just purchased at 197.50, and I will sell them at the spot price of 198.78. That gives me a $1.28 off an immediate profit. And that is referred to as exercise value or intrinsic value, which means it's greater than zero, and therefore it's referred to as in the money. And that's why these blue ones are in the money. This is in the money for $2.78, $8.78, and so on and so forth. Now these, if I were to buy them at $200 and not, well, I can't sell them at a profit because right now $298.78 is the spot price, and therefore the $200 strike price is not in the money, is out of the money, and therefore they are not blue. So the same thing for puts. If I were to buy this, I have a right to sell at 200, and I can immediately buy them back at 198.78, which gives me a $1.22 of a profit, which makes this specific option to be in the money, and which makes this one or these ones out of the money. So that's our introduction to options, and we'll talk about a little bit more in other videos.